Welcome back to Alpha Recap, your quick market rundown after the close. I'm glad you could join us. Today we unpack a huge staking disclosure, a standards milestone for 3D content, and a regulatory note that caught some attention. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Big day across crypto infrastructure, standards, and some heavy trading in a few names, so plenty to chew on.
Let's jump straight into the headline that stole the show. BitMine launched something called Maven, Made in America Validator Network, and they disclosed a massive amount of Ethereum staked. Tom, give us the highlight.
Sure, the headline number was the stake disclosure. 3,142,643 ETH, which the company referenced at about $2,148 per ETH, or about $6.8 billion. Analysts noted that immediately put BitMine among the largest staking operators by staked value.
Wow, that's massive.
Yeah, so what really stands out here is concentration. When one operator holds that much stake, it changes the dynamics. Validator market share, fee negotiation, even perceptions of on-chain liquidity. Analysts pointed out questions about whether those ETH are locked up long-term or redeployed as liquidity needs change.
And the obvious question, custody and redeployment. Are these funds sitting in a vault, or could they be moved around? I mean, when you step back and look at this, that matters for staking yields and for market stability, right?
Exactly. If the stake is long-term custodial, think of it like long deposits at a big bank. The operator can build a revenue narrative around steady validator rewards and custody fees. If instead the ETH is actively redeployed, that changes on-chain liquidity and could create market catalysts when moves happen. So follow-through on on-chain flows and any formal filings or disclosures will be critical.
Big concentration risk.
And that ties directly to the regulatory angle we saw today. Morgan Stanley put out a note reiterating its take on Circle, but flagged regulatory risk in an opaque summary. Analysts said the combination is telling. As infrastructure scales, custody, staking, stablecoins, it draws more regulatory scrutiny. Not a surprise, but definitely a market mover when details are thin.
Right. And we also had some ETF action today that hinted at active trading in these areas. Bitcoin Exposure ETF BITO fell about 1.8% on heavy volume, and that Inverse Volatility ETF TZA dropped about 1.5% on even higher volume. Those volumes were pretty chunky, weren't they?
They were. BITO traded around 140.3 million shares, and TZA around 166.1 million shares. Heavy volume with meaningful turnover like that suggests active position churn. Quant shops, ETF managers, folks rebalancing leverage. When you see that along with big staking disclosures, it signals a market that's managing liquidity aggressively.
Meanwhile, Nvidia traded heavily and barely moved. It slipped about 0.25% to $175.20 on the session, with volume in the 142.3 million share area. What's your read on that?
High volume with small price movement. Classic concentrated interest. It often indicates hedging flows, institutional position adjustments, or algorithmic trading, keeping the price range tight while volume climbs. Execution risk rises for large orders because liquidity gets used up, even if the headline price doesn't budge much.
Shifting gears, standards and content. The Alliance for OpenUSD moved its roadmap forward and created a CMI interest group, characters, motion, and interactivity. What does that mean in plain English?
In simple terms, they're formalizing how 3D assets, character rigs, animations, and interactivity metadata should work across tools. Core Specification 1.0 plus a focused group means faster coordination across platforms. That typically precedes tooling adoption, exporters, engines, asset stores, which can create a downstream demand for compute and high bandwidth GPUs.
I mean, when standards start to gel, you often see a wave of tooling and then enterprise spending. How quickly does that usually play out?
Analysts usually talk about a 6 to 18-month arc from standards to meaningful enterprise investment. First comes spec adoption, then developer tooling, then production runtimes and services. NVIDIA and other compute providers tend to benefit as workloads shift from experimentation to production. Yeah, that tracks.
And on the chip front, there was a small cap angle today. Blaze had a target cut to $3 by an analyst. How should listeners think about that?
That's a good reminder of bifurcation. Big AI compute names capture capital and attention, while smaller vendors face re-rating pressure until they show durable revenue or design wins. Analysts noted valuation concerns for smaller players. It can be a tougher funding and liquidity environment until visibility improves.
Not great for niche chip makers.
On healthcare, there were some constructive data points. Lab Central reported that in 2025, its co-working biotech hub produced 30 new companies, 737 jobs, and 22 new clinical trials. That's a pretty tangible signal of early-stage activity in Cambridge, and a proxy for more deal flow down the line.
And the Rural Health Transformation Alliance from GHC Industries. What's the practical significance there?
They bundled grant strategy, health IT, and implementation support to help rural providers turn funding into sustained change. The idea is operational adoption rather than one-off purchases. That shifts vendor economics toward recurring services if pilots scale. There was also a study flagged by Children's Hospital of Philadelphia on pediatric head injuries and a leaky pipeline that could trigger targeted funding or pilots.
So the common thread in healthcare is funding plus implementation equals acceleration. Analysts said that, right?
Exactly. Capital without delivery models doesn't translate into repeatable revenue. When you see hubs like Lab Central plus structured implementation efforts, the signal is maturation, which matters for health IT vendors, CROs, and services firms over multiple years.
Quick synthesis. We've got scale drawing regulatory attention, standard seeding future compute demand, and healthcare combining funding with delivery. Anything else to highlight before we wrap?
A couple more market micro points. 1. Heavy trading in names like NVIDIA, BITO, and TZA with small price moves creates execution risk for big orders. 2. Watch the follow-through on Bitmine's Maven, whether those ETH are long custodial stakes or redeployed, and any regulatory queries that emerge. 3. The Morgan Stanley note on Circle was short on detail, so the full analyst write-up or a company response could spark volatility.
Good checklist.
And to be clear, analysts note risks around regulation, liquidity, and valuation across these stories. We're presenting the facts and the market context, not making any buy or sell calls.
Before we sign off, let's close with 3 clear takeaways for listeners.
First, Bitmine's Maven launch changes the staking landscape. Concentration and on-chain flows are the near-term watch items. Second, OpenUSD's move toward a core specification and a CMI group is an early signal that tooling and compute demand could pick up over the next 6 to 18 months. Third, regulatory headlines, like the Morgan Stanley note on Circle, remain capable of moving markets quickly when details are scarce.
Solid. If you want to dig deeper on any of those points, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. And remember, if you have questions about anything we covered today, you can submit them through the Q&A feature on the site, and we'll tackle them in future episodes.
Thanks everyone. Analysts note this digest was informational only, no personalized advice here. We'll monitor filings, on-chain movements, and analyst notes, and report back.
Thanks, Tom. And thanks to you for listening. Catch you next time on Alpha Recap. If you have questions, head to stockalpha.ai and use the Q&A. We'll answer live. Bye for now.